Welcome to What's Not Priced In, a weekly investor podcast by Fat Tail Investment Research. In a world of confusion and rapid change, experts Kirill Prakapenka and Greg Canavan look behind the headlines to unveil the hidden opportunities within the Australian stock market. Now, let's dive into today's episode.
What an episode we have for you this week, filled with lots of stock analysis and hard-earned wisdom. Today, where it says the winners and losers of the reporting season so far. We profile Coles, Woollies, Altium, WiseTech, Carsales, Data3, and Hub24. Even Domino's gets a mention, the tech stock disguised as a pizza merchant. Or is it a pizza merchant disguised as a tech stock? Anyway, we then turn to one of the most important questions of them all, when to sell stocks. Using his recent sell decisions as examples, Greg takes us through the sell process. In investing, as in life, it's okay to be wrong, not to stay wrong. Hello and welcome back to the 14th episode of What's Not Priced In. As always, I'm Kirill Prakapenka, and joining me is the one and only Greg Canavan. Greg, how are you?
The one and only.
Yeah.
Getting too big for our boots at episode 14.
Yeah, exactly. Well, I think this is a pretty interesting episode. I think people will quite enjoy it. We're going to talk about quite a few things. Obviously, we're in the heat of the reporting season, so we're going to look at some big winners and big losers, and we're also going to actually look at discuss basically when and how to sell stocks. And that was came from a suggestion from one of our listeners. So thanks for that. And obviously, we do read your comments. We appreciate them. So if you do have any suggestions for what you would want us to discuss, please leave a comment. But with that said, I think the theme of this episode is earnings and earnings expectations. So sometimes I'd like to read out a quote. I have one again today, and this is a short one, thankfully. So here it goes. The ability to properly read market expectations and anticipate revisions of these expectations is the springboard for superior returns, long-term returns above an appropriate benchmark. Stock prices express the collective expectations of investors, and changes in these expectations determine your investment success. And that was from a book that was aptly titled Expectations Investing. So there you have it.
Well, did you want a response? Yeah, I mean, I don't know if I heard the first bit right. I'm not sure if I would 100% agree. And it comes back to there are always different ways that you can earn excess returns in the market. Trying to understand what expectations are to me is really, really difficult. And I don't know how often you can do that. And the stocks that we're going to look at today are a good reflection of how not necessarily difficult, but how tricky that can be. And I think if there's any one theme to point out about this reporting season is that if results have come in slightly better than expected and you're seeing upward revisions to earnings per share estimates, even if they're very minor, then you're going to see a good share price reaction, no matter what the sort of valuation was that preceded that announcement. Whereas if there are earnings have disappointed in any way, which is going to flow through to EPS downgrades in the future years, then that share price is going to fall in the immediate aftermath of that result, no matter how much bad news was sort of priced in before that came out. So you're seeing a lot of really short-term money moving in and out of these positions, and whether that's to do with nervous capital, not wanting to be involved in any type of company that's showing weakness to the 30th of June on the expectation that the economy is going to be weaker moving into the third and fourth quarter of the year, and really paying up for earnings certainty. And I think that's the key. Investors are paying, to me, quite a high price for earnings certainty, and they're discounting earnings uncertainty, which I think that's where you're going to see the opportunities. So whether that discounting of earnings uncertainty continues for the next few months, and it quite possibly could. But I think if you're patient and willing to, I guess, wait and just see how some of these moves post earnings season play out, I think there's going to be some really good long-term buying opportunities. But quite clearly, capital is nervous of any type of disappointment and gravitating towards those upside earning surprises, because it's it's a way that capital can hide, at least for the time being, while it works out what it wants to do.
Yeah, and I think before this, I just shared some price moves in retail stocks versus tech stocks, but then you sort of made the good point, which you sort of just already touched on before, which is that it comes back to earnings hits and misses, and it's really not necessarily about one sector over another. It's more that investors are paying for certainty and discounting uncertainty. And so, obviously, with retail stocks, it's still quite uncertain as to the health of the Aussie consumer. And I think we had some results. Adairs released its results and was punished quite heavily. Kogan released its results this week, also got punished quite heavily on the day. And I think as we speak, Levisa, I never know how to pronounce it.
Either
It
do I.
also it also reported results, and it was at one point down 10%. I think now it's down about 5%. So there's definitely uncertainty about where the retail stocks are going in the next 12 months, and clearly investors are responding appropriately.
Yeah, but then you look at and I would say that some of those stocks. I mean, Levi's is very different. I think it's a high quality stock with a good growth profile. But if you look at Adairs and Kogan, they've had histories of disappointment. So I'd probably put them on the lower quality end of the spectrum. And then you've got companies like Nick Scali, JB Hi-Fi that have reported, and Super Cheap. That have done pretty well in terms of the delivery of their numbers, and the market has rewarded that. So it really comes down to individual company performance and outlook and how they're doing. And I would point out that they're talking about earnings to the 30th of June, and we haven't got economic data out for the final quarter of the financial year yet. But just off the top of my head, I remember the first quarter nominal growth in the Aussie economy was up quite close to double digits. So there is momentum for that financial year, and it's probably slowing into the fourth quarter, and it's certainly going to slow into FY24. So for me, it comes down to what that transition is from very high nominal growth, which benefits a lot of companies. Obviously, it doesn't benefit others in terms of higher costs and things like that as well. But some companies get a really good kick from high nominal economic growth. But I think we're moving back into a slower growth environment. So you really want to be careful about the type of stocks that you latch onto immediately post earnings season, because I think what we've seen in the year to the FY23 financial year is probably going to be very different to what we're going to experience in FY24.
Yeah. And now I think this is a nice segue into the actual stocks themselves. So I think obviously a lot of big heavyweights have reported, and maybe we would start with the negative surprises, any stocks that obviously caught your attention by how negative their results were and how the market responded. I think one of them is obviously WiseTech. Maybe we'd start with that.
Yeah, look, we can do that. I think you mentioned before that there were many good results from the IT sector, and that's because it's a growth sector, right? Like there's a lot of growth coming in there, and it also comes down to what the expectations were going into that result. So for WiseTech, I wrote down a couple of numbers here, and correct me if I'm wrong, I think the share price fell around 20% on the day of the announcement, and post that earnings announcement, EPS downgrades for FY24 have come out, and they've been downgraded by 18.5%. So that's quite a hefty downgrade for a stock of that size and of that sort of growth profile. But when you look at WiseTech, it's still, even though its share price has pulled back, it's still on a PE of 88 times FY24 earnings. Currently, it's only generating a return on equity of 13.2%. So I know it's not, it's probably not in full maturity, full profitability mode. But even if I am reasonably generous and put a 20% return on equity expectation on that, it's reinvesting 80% of its earnings. So it's generating quite a decent compound rate of return on that. I come up with a valuation of around $40. So clearly the market is, and this is how valuations work for tech companies. And we've said before on this, I'm not the sort of person to be asking about how to value tech companies. And I don't think the valuation model that I use is particularly good if you want to latch on to those longer term growth stories. So, but even so, this is, I guess, the risk with investing in these type of companies. Any type of disappointment is going to be really harshly dealt with, and then you have to come out and try to convince the market that your growth premium and the growth story is still intact. So at the moment, I think WiseTech has probably gotten off reasonably lightly, even though it was a sharp share price fall after the announcement. But yeah, I mean, it's still looking, even when you assume higher rates of profitability, it's still looking pretty stretched in terms of valuation. So, and this is why I just really struggle to buy into these types of stories. And look, quite clearly it's done well. Like it's been a really good performer over many years. But you've got to really understand the business, really know what its long-term growth drivers are, and be happy to accept the volatility that comes with that.
Yeah, and I think obviously one comment is that with high embedded expectations, there is a risk that the higher the expectations, the higher the disappointment when those expectations aren't met.
Absolutely.
And with stocks like that are operating on really high multiples, obviously there's a massive expectation of growth, and when that doesn't eventuate, the market gets disappointed. And I think you sort of said that you sort of struggle with your valuation model to appraise those types of stocks. But I guess the question is there actually a model to value those growth stocks, or do people just expand the multiple?
Well, I'm sure there is. If you put in certain, if you have certain assumptions about long-term growth, you can, the inputs, you can put whatever you want in to get whatever number you want at the end of it. And it really comes down to, I think, a very focused understanding of what the business does and what its potential growth is. And there are some really good analysts out there who know how to do that. I'm just not one of them.
Well, I think you're still a great value analyst, Greg.
Thanks, Carol. Means a lot to me.
Well, I think from WiseTech, maybe we can move on to another one. I think that you want to talk about was data hash 3.
Data 3, yeah. I mean, it's been a long running tech company in the Aussie market, a really, really good quality company. We had it in our, I guess, alliance client portfolio earlier this year, and it had run up quite considerably. It was up around the $7 plus mark, and I looked at the valuation, and this is probably part of the conversation that we'll have down the track. In when do you take profits? When do you sell based on valuation grounds? And there's no real easy answer for it. And sometimes you get it right, and sometimes you get it wrong. But with Data 3, I looked at the valuation, and what was particularly interesting with it is that it had a growth multiple on it. It was like, at the time, I think it was a PE ratio of over 30 times, yet its payout ratio was 90%. So it was only reinvesting 10% of its profits. And that's why it had a good divi yield, as well as being on a high PE. And I think it was just priced by the market because it was such a reliable, such a solid company, and the earnings have nearly always delivered, that the market was saying, well, okay, we're prepared to pay for that. And when I looked at the valuation and the rally that we had enjoyed in that stock, I just thought, well, what's the risk and reward at this point? You are getting a bit of risk because a lot of good news has been priced in. And where's the next level of upside going to come? And I just didn't really see it. So we took our profits and sold that one. And it came out recently with I guess, a worse than expected result, and its share price fell quite sharply on the day. It did bounce the next day, but on the day it came out, the share price fell quite sharply. EPS expectations post that announcement, they're down 8%, so not a huge downward revision, but it's decent for FY24. Still trades on a PE of 26 times. But it is very profitable. It's got a solid, consistent return on equity of plus 50%. In the next 3 years, the forecast around 57%. So it's a very capital efficient company. But as I said, it's paying out 90% of those earnings as a dividend. So it's not reinvesting and it's not growing a great deal. But the company has got a growth multiple attached to it, and I think that's the risk, right? So if I just assume the valuation on those metrics using an 8% discount rate, I come up with $5.60 as a estimate of intrinsic value, and it's currently trading, I think, a bit over $6. So again, going into that result, it obviously had pretty high expectations priced in. Any disappointment, it's going to be harshly dealt with.
Yeah, and I think now maybe we could discuss the two contrasting tales of the big supermarket chains, Coles and Woolies. Obviously, Coles released its results earlier this week, and on the day, I think it ended the day when it released results down 7%, and it was sort of flirting with its 52-week low. So for a stock of its stature, and it's quite a big move.
Yep.
And I think both the revenue and profit undershot consensus forecasts, which and I used the market screener to compile those forecasts. So what do you make? And I think this thing sort of stood out to me was its net income margin for full year 23 was 2.7%, although it did report a return on capital about 16.5%, which was slightly better than last year.
Yeah, I think it comes down to the expectations going into the result. And I hope you can see I've got a chart up of the Coles share price here. Clearly, this wasn't expected. That has just fallen very, very sharply. And for a stock of this size, that's quite a big move. What I look at with these companies is their earnings and their revenue and their operational earnings growth, and also their earnings margin. So EBIT margin. So for Coles, you had revenue growth of 5.9%, which was pretty decent. You had EBIT growth of 3.8%, but the real problem, I guess, was a contraction of their EBIT margins of 19 basis points, which is pretty hefty, down to 4.6%. And as a result of that, on the back of that, EPS forecast for FY24 were downgraded by 9.4%. The thing is and so again, a theme of what we've been talking about, if you come out and disappoint and that results in earnings downgrades, your share price is going to be, quite heavily punished. And the fact that going into this result, Coles was on a pretty, stretched valuation. That's where the punishment has come in. So I've just did a quick valuation on it based on a 30% return on equity expectation and an 80-20 dividend payout ratio. So it pays out 80% in divvies and reinvest 20%. And the valuation comes up at around $15.40. So it's trading a little bit above that, but certainly a lot closer to that than what it was previously. But it just goes to show that, especially with these when I say larger companies, Coles and Woolies are very much margin companies. They're huge volumes, and little differences in margins on those huge volumes can make big differences in profitability. So if you compare it to Woolworths had actually a slightly lower revenue result. Their revenues are up 5.7%, but their earnings are up 15.8%, and their EBIT margin was up 43 basis points to 4.8%. So now their EBIT margins are a little bit better than Coles, whereas going into it, they were probably slightly worse than Coles. So there hasn't been any changes to the FY24 expectations, and that's reflected. I'll just move on to Coles's. Woolworths.
Yep.
Woolworths share price actually fell going into this result, and then it's had a bounce when the numbers have come out. But again, based on the numbers that I've got for my valuation, 28% return on equity, pays out 70% of that as a dividend. So it's got a slightly higher growth component than Coles, and I get a valuation of around about $35 using 8% as a discount rate. So it's bounced up to around 37, but around here, it's probably not particularly bad value. And considering that, these are companies operating, yes, it's competitive environment, but it's effectively a duopoly, very reliable earnings. And as long as they're well managed, getting an 8%, if you can buy this at a roughly 8% discount rate, that's a reasonably good longer term investment. But again, Coles slightly disappointed and saw an earnings downgrade. So its share price really, really tanked, as you said, down to nearly, probably more than 52-week lows. What are we back here was sort of January of 2022. So it did fall quite considerably. Woolworths fell into that result, has bounced a little bit. I can't see it rallying too much anytime soon. And that may be on the expectation that I think these companies have probably benefited and profited quite well from the inflationary environment, even though they've obviously got cost inflation that's going to hurt them. They've been able to pass those costs on, and especially in the case of Woolworths, they've had a 15, nearly 16% increase in EBIT, which would indicate that they have done very well in managing those costs and pricing in above that. So, yeah.
Yeah. And I think with what I'm noticing sort of recently is that the stocks that are sort of maybe missing expectations are really getting downgraded quite heavily. And I think we're almost in a general downgrade cycle. And I think you've mentioned this weeks before in a different episode where you were sort of saying the biggest opportunities will sort of come once the market sort of realizes things aren't really as great. The optimism for future growth sort of wanes a little bit, and analysts sort of start then to downgrade their EPS forecasts, which I think is sort of now happening this week and the week prior.
Yeah, well, you're seeing it a lot. Like if you just do a quick look at the market and see on each day the biggest movers and the biggest movers to the upside and the biggest movers to the downside, they're all companies that have reported. And that's obvious. We're in reporting season. But there's probably, wait and see what the wash up is at the end of reporting season. But my guess is that the disappointments are running, considerably above the ones that have outperformed. So, and to me, that's just a reflection of the slowing growth environment. As I said, we've gone from very high inflationary, high nominal growth environment to something that's a lot slower. Again, talking about the US, we talk about all the time the lagged impact of monetary policy. That is still having an effect, and it will have an effect into the second half of this year, and probably even more so. I read a interesting report from, I think it was the San Francisco Fed on their blog, and they did an analysis of the excess savings that were accumulated post-COVID from all the fiscal stimulus over there, and their best estimates are that those surplus savings will run out by the end of this quarter. So by the end of September, effectively, the US consumers going to run down their excess savings. So these are all, I guess, things that have allowed or enabled, especially on the consumer side. And, one thing that surprised me a lot has been this resiliency of the consumer. And you're seeing that in the quality consumer stocks. They're reporting still not bad results. They're still decent. JB Hi-Fi's results were pretty good, even though the Good Guys, was almost, I think, non-existent, the growth in terms of that franchise. But there, people are still spending out there. Qantas came out with a big result today, which was largely within expectations, but it just goes to show people are spending, people are paying for travel, all those sorts of things. And that a lot of that has come from running down of excess savings. So the question is, where does the spending come from once those savings have run down? I don't know what the data is in Australia so much. There was some interesting stuff, and maybe I'll dig it out and we can look at it next week. There was some interesting stuff from the RBA showing offset accounts and how the balances in offset accounts are starting to come down post.
Yeah, we mentioned that at the last episode.
Yeah, right. Okay, so I'm not sure if we showed the chart. I might have went and had a look for a graph after that. So we might.
We don't have the chart. The chart would be good.
Yeah, so we'll bring that in if I remember. A week's a long time, so I'll probably forget. But if we remember, we'll have a look at that and maybe dig into that topic a little bit more next week.
Yeah, but now maybe to more rosier news, and some obviously there's stocks that underperformed, but there were obviously stocks that performed above expectations. And I think why don't we start with Altium, a tech stock that sort of rose quite a lot on the release of its results.
Let's do it. And I'll just bring up the chart
Yep.
so we can sort of see what the market's response was, and a big gap up there. So it's done very well. But even saying that, the 24 EPS expectations were increased. Well, I say only 8%. 8% is pretty decent, but it's not as if it was a double-digit increase. So it's obviously beaten expectations and resulted in an increase in FY24 forecasts by 8%. But okay, so this goes back to my point that the market is looking for certainty, and I would say at almost a high cost. So if you look at Altium, it's now on a PE of 48 times 2024 earnings and 39 times 2025 earnings. It's got a pretty good return on equity of 30%, but it's got a 70% payout ratio. So it's only reinvesting 30%. So it shouldn't be on a huge growth multiple. Now, I don't know the details of the company well enough to say whether that's justified, but as a general comment, I would say that is an expensive price to pay for earnings certainty. And I think maybe it's an indication that capital is just parking itself there until it works out what else to do. That would be my, my short-term interpretation of that.
Yep. And I think maybe then you also wanted to mention Carsales.
Yeah, well, so we'll just go through the other two that I've got here. So we can do Carsales first. That's another one, a very well-known, solid company that has done particularly well. And on the back of those results, it's spiked up again. But even so, the EPS forecast post those results, or the EPS increase in earnings was only 3.75% for FY24. So it was a beat, but it wasn't like it didn't result in big upgrades. And for 2024, it trades on 33 times earnings, and for 25, it trades on 29 times earnings. And it's only got a return on equity of 12%, and it's got an 80% payout ratio. Yeah. So I would say it's got the profitability of a mature company. Now there may be more to come. There's obviously growth. It obviously has a potential for more of a global growth platform than, say, a mature company with just an Aussie market. So that plays into it. But at 80% payout, you're only reinvesting 20% of your earnings, which doesn't give you a particularly big growth multiple, yet it's trading at 33 times. So again, what price are investors willing to pay for the earnings certainty? And quite clearly, they're willing to pay up. And it's the same with Hub 24. Again, you see a spike here post the results up to the highest price since, what are we back here? This was late 21. So this is back in the heady days of stock market. So it's really sort of rallied up to that point strongly. Its results resulted in EPS upgrades of 6.3% for 2024, but that puts it on a PE multiple of 46 times 2024 earnings and 33 times 2025 earnings. It does have more of a growth profile. It pays out around 55% of its profits, meaning it reinvests 45% into the business. And it's got an ROE profile of 14%, moving up to about 17% over the next couple of years. So it is growing profitability. It is growing, but again, you're paying hefty price for that at 46 times 24 and 33 times 25 earnings, which may be justified. Not saying it's not. It's just that if there are any hiccups along the road when you're paying at that price, you're gonna cop a beating if you're on the wrong side of that announcement.
Yeah. And I think one interesting result that sort of surprised me was the pizza merchant Domino's. And we talked about Domino's, I think, in one of the very first episodes, but it actually closed maybe 10% higher on the day of its results, even though net profit fell about 74% to 40.6 million. So if you use that full year profit figure, it's trading a trailing P ratio of over 100. So it's trading like a tech stock, even though it sells pepperoni pizzas. So it's
Well, but it sells them via an app, so it's
Exactly.
a tech pizza stock. I actually don't mind Domino's. I think it's great business. Again, because it does have those multiples priced in, it's hard to, for me, it's hard to determine, what's a fair price to pay. There is, potentially big growth platform from its international operations, but that's a big source of risk as well if there's any disappointments on that front. I didn't look at the details closely. I think there was an announcement about some cost outs that surprised the market, and that was the reason behind the rally.
I think there was a conference call as well, and I think they're going to cut costs. They're going to cut some jobs, and I think they did see, what was it, a material sales and earnings improvement in the first few weeks of full year 24. So I think the market maybe looked ahead in the next 12 months rather than looking back, and sort of thought, okay, this might turn around, because it's obviously been a bit beaten down over the last 12 months. So
yeah, I mean, keep in mind, I'm not sure what the peak share price was, but it's fallen significantly over the past 12 months. So, and that's always a sign to say, well, okay, there's a lot of bad news priced in. But again, it's what price you want to pay to get that future growth, and you need to know the business and the risks quite well. And I think the one positive with Domino's is it's run. It's a really well run business. It's demonstrated that it can move into offshore markets. Not everything has been successful, but it has delivered growth over many years. It did get a massive COVID bump, so I think trying to work out what's a sustainable rate of growth in a relatively normal world is probably a tricky one as well. But yeah, I mean, it goes to show that after a stock has fallen considerably, that is sometimes a good hunting ground to see whether the market has overly sold it. For me, the other question would be, based on those surprise announcements like that, to what extent is that short covering pushing that price higher? Because sometimes stocks like Domino's can be a favorite of short sellers. They might sort of buy into it pre the announcement on the expectation that, yes, those earnings have fallen and there might not be some good news to push it up again. So when there are some surprise announcements like that, you can get some short covering in the short term. So that's why it's good to wait for the dust to settle sometimes and just work out where the sort of real longer term investors are setting the price. Because at the end of the day, and we mentioned this last week, not everyone thinks like you when they're investing. They might be in for a short time. They might be nervous about further weakness, so they're getting out for the time being. Not everyone's a long-term investor, and you need to sort of look at charts and look at the fundamentals and try to get a picture of where the market is putting that, and whether you think that's a good opportunity short term or whether there's still too many risks there.
Yeah. Well, if you can use a pizza analogy, not everyone likes the same pizza. Some people like pineapple, some people like margaritas.
I like anchovies, and I don't understand why people don't put anchovies on their pizza. I think
my Napolitana is my favorite pizza. Just add some jalapenos, but we're getting.
Oh yeah, it's got to have chili. I wouldn't say jalapenos. I'd say that for my Mexican, but chili flakes for sure.
Yeah, chili flakes or chili oil. That's a good one.
Both.
All right. Well, now maybe we can move on to the topic of when and how to sell stocks. I think you were asked by one of the listeners to do sort of a segment on this. So take it away.
Yeah. Look, George sent a tweet. Sorry, I think it was George. My apologies if that's wrong, but I'm pretty sure it was George. And I thought, it's a good topic, and one that I'm always trying to get better at. You're never going to get them all right. Like you're always going to sell too early, keeps going up, you sell at the bottom, then it goes up, or you buy at what you think is the bottom and then it keeps going down. Like there's always those stories that mess with you. And that comes back to the fact that investing is can be a very emotional game. And as much as possible, you got to try and remove emotion, remove any type of connecting your personal worth to whether you got a call right or not, because you're never going to get them all right, and you can't you can't think that that's going to happen, because there's going to be always issues. But there are a few. I thought it was a good question, because there's a couple of stocks that I've done well this year, and there's a couple of stocks that I've had a bit of a shocker on. And I think it's important when you're giving these examples to give real examples of decisions you made, in real time, so you can then have a look and see whether they worked out or whether it was a bit of a disaster. So we'll start with which one? We'll start with Telstra.
Yep.
Because it was a stock that I'd had in the portfolio for some time. Initially recommended it back in 2018. So it was a tough. It was late 2018, I think, somewhere around here, after it sort of rallied from this sharp low. So we'd gone through a fair bit of a roller coaster ride with it, because it looked like it was taking off, and then obviously with the COVID crash all the way back down here, but then it started to trend higher, and it's sort of done quite nicely. But at the end of March this year, so I think it was around 420. The price, the stock price was around 420 when I recommended a sell. And the reason I recommended a sell, and this goes to George's point, he asked something along the lines of, how do you know when to sell from a fundamental perspective versus a technical perspective? So at this point, technically, Telstra is in a nice uptrend. And if you're just looking at the charts, you're going to say, I'm going to keep investing in this and see how far it goes, because the trend can keep running. And that is a really, a sound strategy. But I've found in the last, say, 12 to 18 months that the market doesn't trend and stocks don't trend as well as they did previously. So we're in more of a mean reverting market, which means stock prices can do really well. Then they might mean revert back to a decent valuation level. So I find that just relying on the charts is a lot trickier in this environment, and you really need to look at your valuations and say, okay, well, what's being priced in here versus what risk am I taking, et cetera, et cetera. So when I looked at Telstra earlier this year, I said to myself, well, the general market has gone down considerably throughout 2022. Yes, it's bounced into 2023, but Telstra had outperformed the general market for some time. And that was telling me that the investors were putting a high price on defensive stocks. And when I did the valuation on it, it was really stretched in terms of the valuation. Now, even though Telstra has really good free cash flows, it's got really solid assets. It's got a very dominant mobile division. It also at that point had infrastructure that it was going to spin out and potentially become more capital efficient by doing so. But a lot of that was clearly priced in because the market had been moving up for some time. The dividend yield wasn't particular. I think it was around 4-point-something%. It wasn't particularly attractive given that market rates had moved up. So I just thought, okay, Telstra's outperformed for some time. The market itself has underperformed the stock. The stock's pretty expensive. Let's take some profits and move on to something else, purely because the risk and reward at these levels wasn't too good. So that was, when was that? That was late March, so around here, 420. So after that time, I watched Telstra continue to go up for a few months. I had it in my super fund. I had it in my dad's super fund as well. And at this point, I'm thinking, I should have kept following the charts because, it's continued to trend higher. And at the time, I was reading reasonably bullish articles on it. And as much as you say to yourself, well, I'm a contrarian, and when I see bullish articles, I think that's a good sign. It was also, making me think, maybe I've pushed the sell button too early here. But it turns out that around this time, the market obviously got wind of something in the result. And when Telstra reported last week, share price fell quite sharply. Now, whether that's a vindication of my selling earlier this year or not, who knows? There could be a rally back up to this level. But in answer to the question, it was really just a sense of defensives had become quite expensive relative to the market, and the share price itself had a lot of good news already priced in. So I thought, let's just take some money off the table. We made 50% on it over the recent years, plus a good divvy. It was just time to take some profits because I couldn't see a lot more upside with it. So my guess is that this Telstra will probably struggle for a little while now. I just don't know where the catalyst is to send this higher. When you get a sharp break like this as well, it does happen sometimes, but it's more difficult for a share price to sort of rally back into where it used to be, unless there's a market-wide reason for a general market sell-off that pushes everything down. But what you're seeing at the moment is very much individual stock moves. And if you look at, I'll just quickly bring this up to give a sense of what I mean. When you look at the index itself, it's sold off a little bit recently, but it's still just consolidating within this longer term band. So all the moves that you're seeing in the market are very much stock related rather than market related. So to me, if I probably would be wary of being in Telstra at this point purely because of that sharp break there. Another stock that I sold around the same time as Telstra, I think it was early April, was it? I can't remember where we sold this one. It might have been because it was high $7. I think it was early April. So this is Chorus Limited, which is a broadband owner of broadband infrastructure, fiber infrastructure in New Zealand. Same principle as Telstra. Hadn't owned it for as long. I think it only bought it in 2022. But again, it had outperformed the market. Defensive assets had become put a premium on. And I thought at this price, I just couldn't see where the upside was. Even though if you look at these moving averages, even though the chart was suggesting that the trend was still moving higher, I just thought, well, I'm not sure where more upside comes from. Economies are clearly slowing, so there's going to be potentially some revenue and earnings pressure coming up, and the market wasn't priced for that at all. Maybe that's being borne out now. You're seeing, it's gone sideways a little bit. It's tried to rally again recently. I haven't even seen its results, to be honest, but I'm assuming this is results driven, and you've seen a pretty sharp correction here. It's a good company. It's good, it's got good cash flows, all those sorts of things, but I think it's susceptible to any type of slowdown. And I think the New Zealand economy is probably doing it a bit tougher than the Aussie economy. So for that reason, that's probably why you're seeing this sharp drawdown here. Two other stocks that I sold more recently, and the sort of jury's out of whether I've done that at the right time. IAG, bought that back in May, I think 2022, around this region. So I had to go through some doing nothing for some time before it sort of really got going. Sold this a month or two ago at around the 580 level, I think it was, maybe 585. Continue to rally, but now it's sort of correcting a little bit. Way too early to tell whether it was a good call or not. But again, to answer George's question, it was sold purely on valuation grounds. It had reached my estimate of value. And the other thing I thought about was that, it was the sweet spot for insurers. And look, that sweet spot could continue for another 12 months. I really don't know. But there was a lot of bullish commentary around the insurers. There was a lot of money flowing into the insurers purely because of their pricing power and all that sort of stuff. And when it got to where I thought was a fair value, I just thought, well, again, I'm not sure where the continued upside comes from. There's more risk in owning it here than there was down here. So maybe it's just time to take some money off the table. Too early to tell whether that's a good call or not. So we'll wait and see on that. The other one that I recommended to sell on, quite clearly too early at this point, was James Hardie. Bought this in, I think it was February this year. So it might have been around this correction period from memory. It might have been down here somewhere, but it was certainly in the low 30s. Had a really good rally. Quickly rallied up to where, around this level here, and this rallied up to where my estimate of value was. Again, I thought that the home builders had probably got a bit ahead of themselves given the risks in the US economy. So I didn't really want to hang around and see where this trend took us. I thought, from a valuation perspective,
Mm.
It's more than decent value. More than above my estimate of value. So I thought I'd take some profits. Sold off into its result. Result came out better than expected. Surged up here. So, and they're the moments where you feel like a bit of a clown because you've sold 2 weeks before a good number comes out and sends the share price soaring. But the market struggled to follow through with that, and we've seen a bit of a sell-off here. Still looks like a really strong trend, so it does look like I'm a bit of a clown from a short-term perspective. But we banked a pretty decent gain on that in a short space of time, so you can't get too sort of worried about that. And as I said, you're never going to pick the top, you're never going to pick the bottom, so there's no point worrying about it too much. But let me move on to one where I guess it's a bit more obvious that I was a clown. Is GUD. So I recommended this to my subscribers, I think from memory, potentially on this pullback here. I was looking at it, doing some work on it around here. It surged, and that might have been its half-yearly result that came out in February, surged off the back of that. I thought I'd wait for a pullback, which I did. Then it rallied up, which was quite nice. And then it started to break down here again. And at this line of support, which was the breakout level, even though, and this is where you sort of, you got to try and juggle the competing stories between the fundamentals and the technicals. So fundamentally, GUD was cheap, and I thought it's a really well-run company, and I thought it's considerably below my estimate of value around here. But when it broke down, and it broke down quite sharply here, I thought, hang on a sec, maybe those assumptions are too optimistic. Maybe there's something going on with the business. And this is where charts can mess with your head a little bit, because then you start telling yourself a different story. So this breakdown was a red flag for me. I think I sold it literally on the bounce before it got back above it. So really about here, booked about a 10% loss, I think, on the on the actual trade. And as you can see, literally it has not gone back down to that level. And then its full year announcement came out last week, and it's done very nicely. So George, you don't get them all right, mate. And that's just the way it works, but that's frustrating, because in this market, you really want to try to make sure the stocks that you are picking are the ones that are going up, and not to get shaken out. And it just goes to show that I think sometimes you probably need to give yourself a bit more wiggle room on the technical side, rather than getting too caught up with almost cliched levels of support and resistance. And quite possibly this was just a bunch of people who look at the charts and don't look at the fundamentals of the business panicking. And unfortunately, I got caught up in that sort of concern. And around that time, I guess the other thing to consider is that, when that's happening, you obviously don't know what's going to happen here. So we sort of squeeze past here, and you're sort of looking at a chart that's breaking down. And at the time, there's probably a lot of nervousness in the market. I think there was a general sell-off around this time as well. So you sort of you're in a little bit in capital protection mode. As you can see, these moving averages were about to cross back down, which is a sign that this early upward trend was turning over and giving way. And you think, and that happens a lot. Like, just because these moving averages cross here to the upside doesn't mean they keep going. You often get thrown dummies. But I probably should have given more weight to the fundamental story. So yeah, that was one that I got wrong. And I thought I'd finish off on AWC, because this is one that's in the portfolio at the moment, and I'm not 100% sure I'm not 100% sure what to do. I guess I'm grappling with the technicals versus the fundamental story, because the fundamental story as it stands at the moment is pretty well matched up with the technical story. AWC, Alumina, is having problems getting permitting to access its high quality bauxite mines in WA to feed the refinery. So it's and alumina prices aren't particularly strong. We're seeing commodity prices across the board pretty weak. So a bit of a perfect storm hitting alumina at the moment. And then on top of that, you've got rising energy costs in Australia from from across the board, and they've got very energy intensive operations. So lots of issues that AWC are grappling with. And I think that the thing is, what you should try to do as an investor here, and I've been in this stock for, I'm not 100% sure. I think I might have bought into this. This has not been a particularly pleasing investment for me. I can't remember whether I bought into this, sold out, bought back in again. But we're down around about 30% on this. Maybe not quite that bad, but it's not. It hasn't worked out particularly well. From memory, we might have bought in when these moving averages crossed back up here, and it looked like there was a really long-term support here that had sort of bounced off. I think we got in around about here. So it's done, and then it's gone back down, and it's really sort of dropped. And so technically I'd look at that and say, okay, it's broken support. That's not a good sign. And fundamentally, even though it can't get much worse, it's not looking particularly good, and there's no sort of near-term catalysts. And but then I look at the RSI, which is the momentum indicator on the downside, and that is hugely oversold. So what I don't want to do is sell it at a point where it's massively oversold, because the odds suggest you're going to get a bounce from here. Now, that doesn't mean you're going to get a bounce and a change of trend, but it does mean that there might be better opportunities to get out if you did want to sell. But I'd be sort of probably more inclined to hold on if you do get a nice bounce back above this level of support, because it's sort of an indication that the market's rejected that break lower, and it's moved back into this range. And look, Alumina's got world-class assets. It's got a very solid position in the global aluminium supply chain. So it's not as if you're looking at a poor quality company here. There's just a lot of external issues that it's grappling with at the moment. And so to I guess go back to George's point about what you do in these situations. It can be a tricky one.
Is that your answer? It's tricky, George.
They're always tricky. But that's what the job is. You try to work it out. I suppose what I'm saying is it's not always as easy as just saying stock's undervalued, buy it, stock's overvalued, sell it, or chart looks good, buy it, chart looks bad, sell it. You've got to try to understand what the company does, what situation it's in, this could just be a lot of investors who have been in it for quite some time, and especially if you consider, all this period, then investors have just got fed up and they've just gone, look, I'm out of here. I've been sitting around waiting for this rebound for a while, and it's just not happening. And I think if there's any sort of useful comment I can make, you've got to come to each decision on a stock like you don't own it, like there's no emotional attachment to it. Because if you're selling a stock because you're bored / fed up / impatient of waiting for a turnaround, then that's an emotional decision, and you've got to try to remove yourself from, or try and remove your ego from the fact that you're sitting on a loss, all those sorts of things. And you say to yourself, okay, if I came to this stock today, what would I do? And the honest answer with Alumina is that I would pass on it. I wouldn't buy it, probably wouldn't necessarily sell it. So in this case, it's got to be a hold for the time being, and then reassess it. But the honest answer is I'm a lot more interested in buying it than what I would be in selling it here, purely because it's gone through quite a big correction. I know its assets are quite solid, and when it can't get much worse for a stock from a contrarian perspective, that's when things get pretty interesting. So that would be the story on that one.
Yeah,
and that would be my accumulated wisdom of getting lots wrong over many years of how to think about dealing with when to sell, when to buy, all that stuff.
Yeah. Well, I think you sort of say, it's getting it wrong is part of the game, but I feel like it is sort of almost underplayed by a lot of people. It's impossible to get every stock right. Getting it wrong is inevitable, and I think given the fact that it is inevitable, people need to sort of learn what to do once they do get it wrong. So they have to figure out, well, they have to be aware of when they get it wrong and then know when to get out. And I think it's okay to be wrong, but not to stay wrong. So that's the name of the game.
And we've all had those stories where we've stayed wrong for way too long, and you end up, getting out at way bigger loss than what you wanted to. But it comes down to position sizing. You probably should never be especially for a small speculative stock, you want that to be 1 to 2% of your portfolio. So if it does blow up, and if you do hang around for too long, it's not going to create too much of a problem. Just quickly, one thing that I always laugh about when you listen to interviews or read interviews with fund managers, and someone will prompt them on, tell me your story about one of your worst investments, and they'll say something like, I picked this 10 bagger and I sold out after it doubled. That's your worst one. Sure. It's hilarious. People get badly, people stuff things up, and it's important to acknowledge it. It's important to accept it and say that's a part of investing, and I'm going to try to be better next time and try to minimize, not necessarily minimize the mistakes, because you're always going to make them, but minimize the outcome, the negative outcome from those mistakes. And if you can do that, you're gonna continue to grow and continue to get better.
Yeah, and I think as Howard Marks said, I think the biggest part of investing is almost risk management, risk managing your losses and investing in such a way that you never really blow your portfolio up.
Absolutely.
Yeah. Well, we said this is going to be a 30-minute episode. It's nearly been an hour, so I think it's time to wrap it up. But Greg, thank you for your years of wisdom and distilling it.
No worries. I clearly talked a lot. I hope people got something out of it.
No, I think they would have. And George, hope your questions were answered. But also, if you do have any other questions, leave a comment or tweet at Greg. I think he has a Twitter account. He's quite active.
Canavan2.
Yep.
I wouldn't say it's very active. I sometimes have a love-hate with Twitter, like most people do. But yeah, sometimes
X as it's called now.
Twitter X, sure.
All right. Well, with that said, see you next week.
See ya. Bye.
See ya. Thanks for joining What's Not Priced In, your weekly source of unique ideas in the Australian stock market. Now, if you've enjoyed this episode, please show your support by liking and subscribing, and turn those post notifications so you don't miss a thing. And stay tuned for the upcoming episodes as we delve into new topics, new trends, and new stocks. Thanks for your support. Hope to see you next week.